Pivot points provide a convenient method to detect intraday support and resistance levels. Here is how pivot points are calculated and how you can use them to program a mean reversion strategy for the euro franc.
Pivot points appear as a series of horizontal levels overlaid on prices. By default, they are calculated at the start of the trading day and remain fixed until the close. The central pivot point, PP, is an indication of the previous day's average price. Surrounding the central pivot are the first three intraday support and resistance levels, termed S1 to S3 and R1 to R3. Different types of pivot point calculations have appeared over the years, but I'll use the most common version here, the classic or floor pivot. You will need the previous day's high, low, and close prices. If you're trading off intraday price levels, daily pivots are a good choice. If you're a longer-term swing or position trader, you can also use weekly or even monthly pivots. The central pivot point is an indicator of market sentiment. The market is bullish when trading above the pivot point and bearish when trading below it. Prices fluctuate around the pivot during flat markets. Like standard support and resistance levels, the S1 to S3 and R1 to R3 levels indicate potential market turning points. If a price penetration occurs, resistance levels usually become supports, and vice versa. The chart below shows the dollar Canadian interacting with the pivot supports on multiple occasions. These support and resistance levels are typically used to determine trade entries and exits. For instance, it is plausible to go long when price reaches the pivot supports. Lastly, since the second and third support and resistance levels are calculated using the previous day's price range, the spacing between these levels gives an indication of prevailing market volatility. Let's attempt to fade moves on the 5-minute euro franc, a traditionally ranging market. We first need to address a very important aspect of mean reversion trading, the trading hours. Mean reversion strategies usually perform better during the quiet Asian hours, which is the trading window between the New York close and London open. For this strategy, I'll only open trades within the 0100 to 0900 hour window. Notice that I excluded the first hour after the New York close. This hour usually contains the largest spread and slippage, which can destroy the expectancy of intraday mean reversion strategies. Within this low volatility window, random noise can cause temporary price extensions that quickly revert to the mean. Now that we've decided on our trading window, where should we place our entries? The idea is to expect a reversal when prices reach the support or resistance levels. Recall that the pivot point and its associated support and resistance levels are calculated using daily prices. After some observation, it became apparent that the 5-minute euro franc rarely reaches even the S1 or R1 levels, especially during the quiet Asian hours. To get more trades, I'll use the midpoint between the pivot and S1 for long entries, and the midpoint between the pivot and R1 for shorts. I'll go long when price crosses above the PP and S1 midpoint, and short when price crosses below the PP and R1 midpoint. I like to experiment with limit orders when taking a mean reversion approach. With a limit order, you can get a more favorable price and reduce your risk of slippage. I'll place the limit order 3 pips below the midpoint for longs, and 3 pips above the midpoint for shorts. When combined with the entry condition above, this limit order means I'm betting that prices will retest the midpoint support or resistance after breaking through. This makes sense because quiet markets typically don't exhibit strong rejections of price around support and resistance levels. Prices usually hover around these levels, before gradually moving away from them. I'm hoping the moves will run out of steam after this retest and quickly revert towards the pivot point, much like an overstretched rubber band snapping back into place. Trade exits will be simple. Like day traders, I'll reduce market exposure by closing any open trades at 23:55 hours. A 20-pip profit target and 60-pip stop loss will complete the strategy. Here is the pivot points entry condition. When configuring the pivot points indicator, the start hour and start minute fields let you specify the start of each trading day. Since I'm taking the New York close to be the start of the next trading day, I've input a starting time of 0-100 hours. The limit order price is specified here. The convert pips to price function converts 3 pips to 0.0003. Finally, I toggle the trade management I need, and parameterize the profit target and stop loss distance. I will backtest with 1-minute OHLC prices to get a more precise modeling of the sequence of prices. This improved precision is especially important for lower timeframe mean reversion strategies, where expectancies are small and entry and exit prices are close together. Since the strategy trades during relatively quiet hours, I also specified a 1 pip slippage along with a 2 pip spread. Here are the results from 2003 to 2021. Nothing too impressive, but the equity curve shows the strategy has performed fairly consistently over the years. Recall that this strategy only uses a single entry condition. It offers a good starting point for further development. So the next time you're searching for a support or resistance indicator, do give pivot points some consideration. The central pivot point can be used as a barometer of market sentiment, while the surrounding support and resistance levels indicate potential turning points. Look for impulsive breakouts around these levels if you're a trend follower, or signs of overextension or weakness if you're into mean reversion. For higher probability trades, look for confluence between the pivot points and other indicators such as moving averages, Donchian channels or Fibonacci levels. Be sure to like and subscribe, and stay tuned for more free strategies.